After falling sharply to start the week, global markets rallied sharply on Wednesday and then had a fairly quiet session on Thursday. We're joined now by Marc Faber. He's the publisher of the Gloom, Boom, and Doom report. And Marc, is the kind of volatility we're seeing not just this week, but say the last 6 weeks, is that the sign of a healthy market?
Well, I don't think it's a sign of a healthy market, but it's, let's say, a consequence of zero interest rates. I have argued for years that the Federal Reserve, with its artificially low interest rates, instead of creating monetary and economic stability, has created more instability by creating the Nasdaq bubble, the housing bubble, the commodities bubble, and now creating a giant government debt bubble. And so we're going to have a lot of volatility every year for the next few years, where markets every year will go up and down by at least 20 to 30% per annum. And I think in real terms, inflation-adjusted terms, or gold terms, they will not make much headway.
Well, interesting. So you mentioned that the Fed, so they've created instability in the financial markets, and you said they've created a commodity bubble. There's been some headlines recently attributed to you that you don't believe that there is a bubble in gold, though. Why not?
I don't think there is a bubble in gold because, first of all, whatever you read about gold, everybody seems to think that there is a bubble. And it's the same people that thought that gold is a bubble when it was at $400, at $700, at $1,900. Now, can gold correct meaningfully? For sure. In the great bull market for gold, 1970 to January 1980, when gold went from $35 to $850, from December 1974 to August 1976, the gold price dropped 40%, and then it went up 8 times.
Right.
So yeah, we can have a correction to $1,500, $1,600 on the gold price, but believe me, as long as we have characters like Mr. Obama equals 0 and Mr. Bernanke, gold will be very well supported.
Right. Do you have a target in mind of how high you think gold can go? It's as you mentioned, there's been some volatility in gold the last couple of weeks. And just this week it went to 1920 and then back to 1840. As we're talking here today, it's trading around 1870.
Quite frankly, I have no idea how high gold will go. But I think it will go higher. And according to some statistics, the gold price today should be worth, say, between $6,000 an ounce and $10,000 an ounce. And all I can say is that since the late 1980s, we have had a huge wealth creation in the world, in India, in Brazil, in Vietnam, in China, and so forth and so on, and in Russia. And when you compare the price of gold to this wealth creation, then I think the price of gold is still relatively low. When I compare the price of gold to the monetary base around the world for the last 20 years, I think gold is still relatively low. When I compare it to the quality of politicians in the world, I think gold is dirt cheap.
You've also said that you think the S&P 500, the peak from 2011 at around 1370, that will remain the peak for a very long time? Because it seems like, in absolute terms, the stock market can do well if the Fed continues to be so accommodative.
Yes, I agree with you. I said that earlier this year that the May 2nd high for the S&P at 1370 would be the high for this year. And then we dropped to 1102, and now we rallied to over 1200. I think the super bears this year will be wrong and the super bulls will be wrong. and that the market will kind of have a trading range. But obviously, if the Fed prints money like water, which is not totally unlikely, then the value of money will lose. In other words, the S&P could go from this 1,200 level here to say 2,000, but in gold terms and inflation-adjusted terms, it could go down. So I am not a heavy short seller, but I can understand the argument of the deflationists who argue that the private debt collapse, in other words, the private debt contraction will exceed the government's debt creation, and that therefore the S&P will collapse to 400. I can understand that, and I have sympathy for that. That's why I'm telling investors, you should have about 25% of your money in stocks. You should have about 25% of your money in real estate, about 25% in gold and silver, and about 25% in cash.